This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Alright, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis of the channel and check to see if, largely speaking, things are still going according to plan. So as always, we're going to run through this thing from the top down. There are no mid-roll ads, so if you would be so kind as to show some appreciation by hitting the like and subscribe button, that would mean the world to me. And of course, you can follow along as we continue to check in on this week in, week out. So kicking things off with the stock market, at the lows, we were too bearish. And I said we were going to have a blow off tops at all-time highs, come tumbling down in a bear market, a global recession, and slip into asset price deflation for a short period of time. It is also our thesis on this channel that we would likely, once we have seen the highs, enter a lost decade whilst this momentum oscillator down the bottom resets itself. And as for looking for the time of the top coming in, we continue to make the case that we are on borrowed time here and this top will likely be no later than Q1 next year. The base case on this channel is it will be this year, but we are open, of course, to staying long and strong for a while longer if need be. The S&P has a 4-year cycle and it is due to form sometime late 2026. Everyone knows that Bitcoin has its 4-year cycle and that low is also synced up to form late 2026. As is the half cycle low in gold's 8-year cycle. So we continue to expect this blow off top to reach a climax sometime in the coming months as we then start to see the market head down for those 4-year cycle lows. Fast forward to today, and I make the case we are well and truly in that final blow off top now, as I said, and we are just waiting for this thing to break down and then start to head for those 4-year cycle lows. It's been a good run. I think this tariff tantrum spill right here corresponds to this bear trap before the final move higher. And again, I keep drawing parallels to this. I say if we draw a line across the top here, okay, where are we on this chart? I think we're about here. We are somewhere approaching FOMO right now, I think. And if we go back here again, we can do the same thing, right? We can draw a line across the top and say that I think we're about to approach FOMO. I think we are approaching FOMO and about to start to moon higher. And of course, once this thing breaks down, I expect it to be quite a spectacular violation into those major 4-year cycle lows late 2026. So for the stock market, I think the read is pretty clear. I think we're still on the right side. When we get to the end, as always, I'll show you the TA and the live positions that we've got on this channel. And we're going to continue to be long and strong for a while longer. But make no mistake about it, okay, we are getting stretched, at least according to the cycles and according to me too. For Bitcoin, we've been trading the weekly cycles the whole way up, as well as some daily cycles in between. And we continue to make the case that out of each weekly cycle low, we see approximately speaking a double from the low to the high. At least that was the case until the prior weekly cycle where we were forced to leave everything to the left-hand side of my cursor untouched and squish the right-hand side down. So that's what this adjusted chart is right here, because we had to squash it all down because Bitcoin did not stage a double from the low to the high. It only managed about 70% low to high. I say only, that's nothing to be sneezed at, mind. And I think we're now in the timing window to see a bottom form, to see a new weekly cycle begin and another upside push, which I am making the case will be the final high in this 4-year cycle. Before then we break down, head for this weekly cycle low, and then left translate and fail again to give us the next weekly cycle low, which is also the 4-year cycle low. I do note a couple of things here. Number one, the sentiment is completely washed and reset into this cycle low, very, very similar to what we had back here and back here. This one was dealt with pretty quickly and in pretty short order and was early in the cycle, so didn't have too much of a sentiment reset to it. But this one was certainly very washed in terms of sentiment, so I think we must be close to a turn here and a new weekly cycle beginning. I also wanted to point out that one of the members did a bit of maths on this thing, okay? And if you average the 94, the 98, and the 90% right here, you get about 94-95% average gain between each one of these cycles, okay? And then if you average 120 and the 70%, you also get about 94 or 95% gain. So instead of calling this thing the weekly cycle low and double, this is actually being the weekly cycle low and 94% upside, okay? But what I'm trying to point out here is if we're to get another 94% gain here, which would just be bang average, it would be exactly the average of all of these prior cycles. That, of course, would put us somewhere around 194k. I think that's okay. And I know a lot of people are very quick to say, no way, Camel, that's too bullish, like the thing has topped, blah. And that might be the case, okay? We are still open to the idea that we just get a lackluster bounce, a rollover, a left translation, and a fail, and then the cycle looks like this, okay? We've been very consistent on this channel as saying this is the bearish case out of this weekly cycle low. And even though we're cheering on the bullish case, we have to be open to seeing a bearish rollover like this. But although a lot of people say this is absolutely crazy, it could not happen, okay? This is far too bullish. This is just hopium. I'd like to point out that if I grab this fractal, okay, we literally have seen this every other cycle, okay? This is what it does. It stages these big rallies, and if we are to do another one of these, it would put us just shy of 200k. okay? And that would actually, in hindsight, not be out of character for Bitcoin to do that. In fact, if we stage a 94% rally from here, it would literally be exactly what we did back here, and it would also be bang average for every other weekly cycle low. So I'm going to continue to stand with this as my base case, and of course we will invalidate this idea if instead of getting this blow off top, we get a lackluster rollover and a bounce like this, in which case we'll be cutting the trade upon left translation somewhere in this neighborhood and looking to target that 4-year cycle low. So I know people's patience are running thin here, and that's okay. I've had the same system. I've treated every one of these weekly cycles the same, and I'm going to continue to do that. We are going to continue to wait for this thing to confirm with a trendline break and all the other signals we use on this channel, like the DSS Brexit cross. And once the thing is confirmed, we will then set a new hard invalidation for the bull market, okay, which is currently, this is the prior weekly swing low. And we don't have a break in structure, a break in higher highs and higher weekly lows until we lose 74K. But the moment that we confirm a new weekly cycle here, which I make the case we are probably close to doing, just days away now, we can draw a line under this weekly cycle, and that becomes the new hard invalidation and the line in the sand for the bull market, which, given that we allocated down here, okay, to walk away with a minimum of about 100K, I think would be pretty sweet. So I remain a lot more cautiously optimistic than I think most people at the moment. And I don't think many people will be very happy with me cheering on 200K. But again, like I said, it really isn't out of the ordinary. We have literally seen this every other weekly cycle, okay, on average. So that's my posture, and I'm sticking with it until the market shows me I need to adjust. And if need be, I will adjust. If we're going to have a recession, which is part of the call, I also maintain that we are going to slip into a short period of asset price deflation. And this is where things get, for me at least, quite interesting, okay? This whole idea is derived from the idea that anything you do to the MT rate of change shows up in the CPI with a lag. Shout out to E here, who has kindly put together this trading view tool for us, where we can track this thing in real time. And as you can see, this thing is still in a heavily disinflationary trend. It is still trending down. It's still moving to the downside, right? Now, a lot of people are quick to zoom in on the trueflation curve and say, inflation's bottomed, inflation's sticky, and all that kind of jazz. And I'm still sitting here saying that those same people said the same thing back here. And then in just a number of 4 to 6 weeks, inflation went from about 3% to below 1.4%, according to the Trueflation. And I've been making the case that we are soon to see this plummet to the downside. And then, of course, all of this will continue to move to the downside as well, and all will be right with the world, and this call will still be well and truly intact. This call starts to get extremely interesting to me because for this month, apparently we are not getting an inflation report being released since the government is still shut down. Now, this could change, okay, but it hasn't changed yet. And the reason I think this is so interesting is when we look at things like the nowcast, inflation in black or dark blue, whatever color this is, okay, has just tanked. It's just completely cratered. So I find it curious timing. I find it suspect that right as we know we should be due to see some rollover in the Trueflation data, which by the way is not seasonally adjusted, but they are going to have to do that soon. And when they do, it should lead to a heavily disinflationary trend here. Right as all that is occurring, we're apparently not going to get to see the next inflation report, and we have nowcast confirming our suspicions, which is seasonally adjusted, okay? So pretty interesting times. We continue to point at things like shelter here in blue for CPI. This is CPI shelter in blue, being one of the biggest laggard components in the CPI basket. And we know that if you substitute for a real-time metric like ALNRI in red here, that this component of the CPI basket has been deflationary for over a year and a half now. Okay, and here's what it looks like if we substitute delta with ALNRI for both headline and core. Okay, they are well below 2%. So, and I continue to make the case that many investors and traders just simply do not understand what is happening mechanistically here. They look at the prices in the supermarket, they see that bread and milk continues to move up, and it will continue to move up, okay? And they conclude, therefore, that inflation is sticky, inflation is persistent, and inflation is still a risk here. When in fact, we are not measuring, at least pertaining to the macro, absolute inflation. So therefore, the bread and the milk in your supermarket is going to continue to get more expensive, but the CPI metric and the rate of change, which is what we are measuring here for the macro, is going to continue to crater and is eventually going to slip into negative CPI prints, aka deflation. Okay, that is where this whole call comes from, and that will translate to this line down the bottom, moving into asset price deflation for a couple of months, probably around the middle of next year, before then reversing higher later in life. And of course, that should also translate to trueflation dropping off a cliff, just like it did back here to new lows. All the people that have been jumping up and down and screaming inflation is sticky and all that kind of stuff will once again go quiet. So I still make the case that so far, this call is well on track. Now, as I said at the start, the call is for us to slowly be on our way into a recession. And on the way there, we would continue to expect to see the labour market deterioration. which makes up the next part of this call, that the unemployment rate is going to continue to tick up. There is going to be consistent and persistent labour market deterioration before eventually we slip into full-bore recessionary territory. And at the moment, of course, the government is shut, which makes getting hold of new data tricky. But the last data we have to go on is ADP missing at the same time as the Federal Reserve is apparently losing 20% of the data. At the same time as we are coming off the back of record revisions down to all of the jobs data. And despite a more recent JOLTS data print, which seemingly corresponds to, quote, a robust, stable and strong labour market, when we scratch beneath the surface just a little bit, what we see is record layoffs sweeping through some of these very large companies, many of which at levels not seen since the GFC in 2007. Meanwhile, the recession signals continue to move in the direction of recession. This is the Piper Sandler recession indicator. It's not backing off at the moment. Construction quits, which is a leading indicator, again, is at levels not seen since the GFC, which again fits with the idea that these cycles are getting ready to enter the topping zone and start the declining portion of the cycles. And then when we check in on the labour market deterioration, right, this is the unemployment rate. Again, there's no real updates coming out because the government is shut down, but I think they're going to soon reopen. And when they do, we should start to get some more data here. But if we ask ourselves the simple question, is this showing any signs of improvement at the hard right edge? The simple answer is no. Not yet, okay? Now, it can change, and it can change quickly, but it has not changed yet. The absolute same is true of unemployment rate for 16 to 24-year-olds. Look at this. Deterioration is clearly visible. This trend is clearly persistent, and there are no signs of improvement. The absolute same is true of U6, which again is making higher highs at the hard right edge. All of these looks are strikingly similar to the lead-in phase before the accelerative pop, which is synonymous with all prior instances of recession. And so again, we continue to point to this labour market deterioration amongst all of the other suspect stuff that's happening, such as those downward revisions, such as losing the data, potential hacks to the system. And we continue to make the case that actually the labour market deterioration is not only in a consistent trend towards recession, but it is also likely a lot worse than they are letting on. We also know that the Fed is primarily using this perceived sticky inflation and perceived robust job market to make decisions pertaining to whether or not it should hold or cut interest rates. But on this channel, we know that none of that matters, right? We know that it's the bond market in aggregate that determines rates, and that's why we often say tell that to the bond market, which simply means it doesn't matter what anyone's opinion is on this kind of stuff, because we literally just use the bond market futures to tell us whether or not rate cuts are coming. Now, at the moment, there is not a high degree of certainty in here, simply because the yields are currently staging a counter-trend rally. But as that counter-trend rally hits resistance and fades, you can expect this thing to reprice in this direction, and thus, by the time we actually get to the 10th of December, we will be cutting rates again by another 25 basis point, unless, of course, the bond market decides to price that out. But I don't think that's going to happen, not based on the structure of the yields. But herein lies the key detail, okay? Investors in aggregate are looking to these rate cuts as bullish. They are looking at these and saying, this is liquidity coming to the market, this is financial conditions easing, and this is conducive to many months of upside ahead here. But we, however, continue to make the case on this channel that these are not going to be cuts into normalization and a soft landing, but rather cuts into a slowdown and a recession, in which case, normally by the time we get 3 months plus past the rate cuts, we see bearish action for the stock market. Now keep in mind, the upcoming cut in December is now going to be the third cut since the resumption of cuts following the pause. So as of December's cut, just based on averages, we should start to see some bearish price action in the stock market. And again, this would make perfect sense because the stock market is currently going parabolic, and as I showed you a million times already, is also getting stretched in its 4-year cycle ready for that decline. So I continue to make the case that whilst investors are looking at perceived sticky inflation and a robust labour market and rate cuts being bullish, in fact, all three of those things are 180-degree flat wrong, and we are just moments away here from entering a recession, probably no later than 2026. And so again, we can stay long and strong until these trends break and we get change in direction. And we'll continue to use alarm signals on this channel, such as the high yield credit spreads, which at the hard right edge are starting to come alive, aren't they? Now, we would expect to see the trend break in the final blow off top moment for the stocks here occur with the high yield credit spiking. Okay, this is what we use as an alarm signal. Spikes in high yield credit spreads is synonymous with financially stressed conditions. So at the hard right edge, we don't have any real alarming signals just yet, But if those breakdowns occur in the stock market as this starts to blast off higher, that will for me be a confirmation signal that that breakdown really is for real, and it not only is for real, but it is likely the top as we then head for those 4-year cycle lows over a period of around 12 months of decline. Now, a similar concept applies on this channel with the yield curves, okay? When the yield curve inverts, everyone screams recession, and they are wrong, and they do the exact same thing when it reverts back above zero, and again, they are wrong, because the nuance is the accelerative sweeps to the upside that are synonymous with the tops coming in for the stock market. And so we continue to use these also as our alarm signals and confirmation signals on this channel of when we need to actually exit the market and run for the hills and get a defensive posturing here. All the while, this continues to trade in a range since the April spike, okay, since the tariff tantrum spill. We can continue to stay long and strong with no real alarm signals. But the moment these start to break higher and put in that accelerative sweep, which is historically speaking synonymous with the tops coming in for the market, right? This was the C19 era, this was the GFC, and this accelerative sweep here was the dot-com bubble burst. So the moment we get those breakdowns in the stock market, and indeed the rollover in Bitcoin, coinciding with these yield spreads blowing out to the upside, again, we will point at this and use this as confirmation signals as well as alarm signals. That really was the top, and we really have begun the bear market, the global recession, and the decline into those 4-year cycle lows. Once more, we will sharpen this yield curve from the 10-year 2-year to the 10-year 3-month yield spread, which gives you even less time to react. Now, this is where things start to get super interesting, because as of right now, this is the second weekly close above the breakout level for the 10-year 3-month yield curve. Okay, now this one is extremely interesting because historically speaking, by the time this one starts to sweep to the upside, okay, the top is already in. So I'm not going to be super concerned here until such time as we get new highs above this prior weekly close from back here, okay? But the moment we do, it will likely have occurred with the trend breaking in the stock market. It will likely have occurred with having already seen the top for the likes of the precious metals and for Bitcoin as they are all heading towards those major 4-year cycle lows in 2026. So this is not to be confused with me being a doomer or me being a perma-bear or anything like that, because we are still extremely long and extremely strong across the board, as I'm about to show you when we move into the live positions. But it is just simply to acknowledge that we are late in these 4-year cycles. They are all synced up for a big decline into next year. All at a time, I might add, when the macro supports us entering a recession. We may already be in a recession, and we just never really know about it until after the fact, since the NB, who are officially in charge of dating recessions, does so normally about 12 months after the fact. And so we can stay long and strong for a while longer, but it is time to pay attention here and respect breakdowns when they occur. So here is our most recent position for the stock market. We have been playing the S&P 500 out of this cycle low from back here, and we continue to push the trade, right? So far, I make the case this is nothing more than a half cycle low shakeout that should resolve higher in just days. Unless, of course, we're to experience a trend change here, in which case we might have to head for a weekly cycle low. But so far, so good, right? Long and strong, and if we have to take some profit here, then there are worse problems to have. Gold continues to look like it has topped for me. We have mostly walked away from this market since first trading it from back out of the 8-year cycle low. This market surpassed even my expectations, and I was one of the biggest bulls in the space from down here. We are still positioned via a few mining ETFs and via a most recent silver trade, but I don't have high hopes for that. It was just kind of a way of me positioning myself just so that I can win in either case, right? If the market wants to rip higher, then we still got a few positions to capture that. And if not, well, we caught the rest of the move and we still have plenty of exposure from the weekly cycle lows back here and the likes of the ETFs and that kind of thing. So we can continue to push those trades for a while longer if need be. We still have plenty of open profit on these things. And even if this resolves to just a lower high bounce and a rollover to reset the weekly cycle, we can use that to let ourselves out, no problem. But like I said, I think pretty much we have done our job here. We caught this move. We traded in and out of it the whole way since the 8-year cycle low. And it's now pretty much time to walk away from the market and let this thing correct and chop sideways into that half cycle low at the end of next year, where suddenly it becomes extremely attractive to me again as some large trades out of that half cycle low. And then Bitcoin, we drew this yellow squiggle, okay, and we said this is what we're expecting to eke out that weekly cycle low to then have that big push, hopefully to around 194k, right, based on the weekly cycle low and double chart. We'll find out. I don't know if that's realistic or not. We will find out. It seems reasonable to me, but who knows? The sentiment is extremely washed here. But we're still long and strong from spot down at the 4-year cycle low, and we still continue to add positions on the way up. I'm likely going to play this bounce out of here once it confirms in some of the crypto stocks in the level 3 members section, because frankly, I think the reaction is overdone in some of these. So I could see myself adding one final time as they complete their 5th waves into the tops. And I mean, that's pretty much it. The other option, as I've said a million times, and I've been saying for weeks now, is we should get a lackluster bounce out of here in the bearish scenario and a rollover, and then it will just do the yellow squiggle from there. If so, then we will just have to cut the trade here and respect the fact that the cycles are down. I'm not one of these people that is talking about a 4-year cycle not existing or breaking or lengthened cycles or anything like that. The only way I could be forced to pivot my stance from this current expectation of either a left translated weekly cycle to new highs before correcting down into the 4-year low, or the lackluster bounce before doing the same thing. The only way I could change from that stance is if this current weekly cycle were to right translate heavily. Okay, do something like this, then we can talk about perhaps having a slightly different approach to this 4-year cycle low. But I really don't think this is going to be a problem as it stands at the moment, right? This is what everything is synced up to do, and I don't see any reason to doubt that. So overall, I make the case that we're still on the right side of the trade. We're still on the right side of the macro. We still are positioned long and strong, and for good reason. I don't think there's any reason not to be, right? We're going to continue to trade this thing publicly in front of everyone with the public invalidation levels the entire time. And we're going to continue to extract extra beta from the market using those higher beta instruments in the level 3 members section. So if you're a level 3 member, look out for the members only video I'm about to post for you guys. For everyone else, I hope you enjoyed this. I hope you consider subscribing and following along week in, week out, because we got to be close to calling some tops soon, right? Like as soon as we start to break down from these levels, it's going to be time, right? It's going to be time. It is what it is. So I'm your boy Camel. I hope you have a fantastic weekend. I hope you consider following us along in this journey. And until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel